Hi there, Sean Howard here from Mortgage Architects. So you're purchasing a home and you're putting less than 20% down. The first thing that you should be aware of is that the government is going to be involved in this transaction. And the reason why is because the banks are mandated to introduce government insurance, which could be CMHC, you've probably heard of it, Canada Guarantee or Genworth. The mortgage needs to be insured by one of those institutions, and it's going to be your responsibility to pay for the insurance premium on that mortgage. And the insurance premium is added to the mortgage, so it doesn't really hurt you that much. Like, you don't have to pay it out of pocket up front. It's added to the mortgage and amortized over the 25 years of the mortgage. It will be a 25-year amortization. The criteria to qualify for this type of a mortgage, which is called high ratio, anything below 20% as a down payment is considered high ratio. The criteria are more strict. You have to pass the infamous stress test. You have to have better credit than you might otherwise need to have. The good news is that the rate is going to be really good if you qualify for this type of a mortgage. When we're checking to see if you're able to afford this mortgage per the criteria of the bank and the insurer, it depends on your income for sure, and you need to have stable income, guaranteed, or an average that can be used. If the yearly gross income that's coming into your household is going down over time, over the past 2 years, then we have to use the lower of the two amounts. If it's going up, then we can use the average. If the income is guaranteed, then we can use the guaranteed amount. The amount of income that can be used to qualify for a mortgage also depends on your debts. So if you have really good income, like let's say you make $100,000 or more per year, and it's guaranteed, that's great. But then we discover that you have a lot of credit card debt or an unsecured line of credit, student loans, personal loans. The unsecured debt, which means the debt that is not secured by a property, like credit cards, weighs very heavily on your income. So it weighs it down. So if you have a balance on your credit card, we have to take 3% of the balance and then take that amount. We consider that amount as your monthly payment, your monthly liability on that credit. Okay. So even though you can make the minimum payments on your credit card and you actually don't have to pay that much, the bank looks at the worst case scenario where you're paying 3% of the outstanding balance, and that weighs very heavily on the usable income to qualify. So again, it's just to say that that will reduce your affordability to purchase a home. And then the other things that will factor in as well are the property taxes of the home, the size of the home, so the heating costs. If it's a condo fees weigh extremely heavily on the usable income, okay, because it's another liability. So mainly when you're purchasing a home, we look at 3 different things. We look at your down payment, and it needs to be at least 5% saved up or gifted by an immediate family member. We look at your credit history, not just the score, how much you've used it, how many trades that you have. And number of trades is like number of credit cards, different credit cards or loans that you have. And then the third thing that we look at is your income. Okay, and taking all of those factors into consideration, then we can give you a pretty good idea of what you can afford with that scenario. Sometimes what we'll have to do is you may have saved up more than 5%. Let's say you have 10% down, but you can't afford the home that you're looking for. Sometimes we need to get a little bit creative and take some of that money that was destined for the down payment and redirect it to pay off some of your unsecured debt, your credit cards. And you're doing yourself a big favor by doing so, if necessary, to get you into the home. It allows you to qualify for the mortgage by reducing that unsecured debt, which it weighs much heavier than mortgage debt, where you're paying a small percentage and it's amortized over a long period of time.